Good morning and howdy. I'm Keith Fitz-Gerald. Welcome to the 5 with Fitz. Let's get to it. The markets were off to a good start early. Then came the ADP jobs report, which showed that private payrolls dropped unexpectedly by 32,000 people. Now, Treasury yields, of course, dropped immediately. Remember, yields and prices go in the opposite direction. So if you recall yesterday's discussion about the cost of money, you know why. See number one, by the way, in yesterday's 5 with Fitz. The cost of the VIG, the borrowing, just went up. So what now? Well, that depends on the flow. Something else that we've been talking about for a lot in recent weeks. The rising tide, a rising tide raises all boats, just as an ebb tide causes them to retreat. I think I've got that right. Ebb and flow. Anyway, there's plenty of profit potential in both directions. That's what you really want to think about. Now, I believe there's a good case that the buyers return quickly and possibly even by the time you watch this. Short-term SPX or speculative leverage fund on the same index for the day might be an interesting choice or interesting choices. Longer term, you of course know the drill just like I do. Buy the best, ignore the rest. All right, here we go. Here's my playbook today. A speed round, markets, mayhem, and money. Now, my good friend and colleague, Scott the Cow Guy Shality, so named for his old school pit jacket, kindly invited me back yesterday to his show to talk about all sorts of things that you may find interesting and potentially very profitable. Some of what we covered includes a pop or drop for Christmas, Bitcoin, must latest, and more. So enjoy the video. You can watch it elsewhere on the channel. Number two, CrowdStrike sticks it to skeptics again. Now, I told the super savvy Stuart Varney Monday morning that CrowdStrike was the one to watch when it came to earnings. I called out a few things specifically. Cybersecurity is a global priority. CEOs are in blank check mode. The company is at the top of the leaderboard. And yes, it can go a lot higher. Now, it seems I might have been onto something. The company's numbers came in. It just delivered one of the best quarters in its history. Not easy to do. Record net ARR of $265 million, up 73% year over year. Why you want to buy a utility with 5%? I mean, really? It's just amazing. Anyway, ending ARR of $4.92 billion, up 23% year over year. The total revenue hit with $1.23 billion, up 22%. Free cash flow hit $296 million, another record. Customer adoption, 6, 7, 8 modules hit new highs. It raised full year guidance again, sharply higher over the next 3 to 5 years. Not immediately, but definitely is the possibility here. Anyway, today's earnings reinforce exactly why I said those things. Not for nothing, but the stock is up roughly 140% since the lows put in following the CrowdStrike global incident in the summer of 24, when I told you point blank that A, the naysayers would pay a terrible price for selling out, and B, to buy in if you were serious. Now, I hope to heck you paid attention. The game is just getting started, in my humble opinion, which is why, by the way, you know where to find me if you'd like some help with the playbook or a kick in the keister if you're uncertain about what to buy, why, next, and how. I've got a few ideas that might help. Anyway, number 3 today, MicroStrategy just admitted what nobody thought they'd ever say out loud. All right, here's the deal. MicroStrategy, now calling itself Strategy Inc., is finally learning what happens when your entire business model is really a leveraged Bitcoin trade wearing software company costume. Bitcoins fall from $126,000 to the mid 80,000s, torched the company stock, which is down 40 to 60%, depending on which day you measure. Now, the company is openly warning that it could lose up to $5.5 billion this year if Bitcoin doesn't bounce. That's a big if, and it's a big B, by the way. For the first time ever, management has created a $1.4 billion US dollar reserve just to make sure the company can meet its obligations. Not to mention the VIG on $8.2 billion in convertible debt that they used to buy all that Bitcoin in the first place. Here's the tell, though. They now admit that if their company's MNAV, market NAV, drops below 1x or gets near the danger zone at 0.9x, they may have to start selling Bitcoin. So much for sailors, hey, we're never going to sell kind of thing. Anyway, when your collateral erodes and your lenders tighten the screws, Philosophy, as nice as it is or as cool as it sounds, gets replaced by the math real fast. MSCI is even reportedly reviewing the stock for possible index exclusion. Think about that one for a minute, which could spark billions in forced outflows from passive funds that own it. My POV is simple. MicroStrategy isn't trading like a software company anymore. It's trading like a leveraged Bitcoin ETF with a payroll. That's very dangerous in a market full of forced liquidations, rising rates, and Chinese crackdowns, and the risk-off sentiment. Now, unsuspecting investors who get burned risk the same kind of re-entry that doesn't exactly get talked about at cocktail parties. One more leg down, and the company that preached HODL, hold on for dear life, may wind up preaching BFDL, bailing for dear life. You don't want to get caught in the middle of that if it happens. A few speculative put-keys could be spicy. And so too for calls if there's a rebound. Anyway, Keith's investing tip in this department: do not make the mistake of thinking you're investing when the markets could easily prove that you're speculating. All right, number 4, Microsoft. Is the company in trouble? Well, only if you ask the Chicken Little Brigade. There's a report out this morning from The Information that Microsoft sales quotas have been lower for AI software sales. Now, shares are sinking as I record this because the presumption is that this is bad. My reaction? I'll take that bet all day long, and I hope you do too. Reports like this are a dime a dozen, but try telling that to the Chicken Little Brigade, which can't be bothered. The question you want to ask yourself as an investor is, what other reasons could there be for lowering quotas? My experience is plenty. Quotas can get tweaked for 100 different reasons that have nothing to do with weakening demand whatsoever. Here are 3 from the real world to get your brain started. Number 1, sales cycles are accelerating, meaning reps don't need monster quotas to beat plan. Number 2, product bundling is shifting, especially as Copilot adoption hits escape velocity. So there could be a change in focus. And number 3, Microsoft may be simply rebalancing incentives, pushing field teams towards high margin recurring revenue rather than that kind of sale. But there's a dozen other reasons. Anyway, those are just 3 that come to mind. AI isn't slowing down, folks, and it's sure as heck not going away. Now, I think the company reaccelerates when the real story comes out and enterprise budgets reset in Q1 26. So you might have a great opportunity here. At least I think so. Anyway, investing tip in this department: Keith's rule of the back page applies in spades, meaning that the real story and the investable opportunity is almost always found in situations like this on the back pages, not the front pages, and especially not with reports like the one in question from The Information, to which, by the way, Microsoft has declined to respond. So you might want to think about that one for a second. Do your portfolio a favor. Buy the best, ignore the rest. And finally, number 5 today. This one's going to be controversial, so brace yourself. But why China's going to love U.S. fuel standards, the new ones, and how to invest before everybody else figures that out. Let me explain what I'm talking about here. This is a deep thought, and you're going to want to pay attention. U.S. President Donald Trump wants tougher fuel standards for gas-powered cars, and he's about to raise the bar. So good, right? Well, if I'm being honest, this is tremendously short-sighted thinking, and it kind of makes my head explode. Not because automakers can't beat them, and not because of the politics. In fact, every major manufacturer on the planet could likely hit these targets tomorrow before lunch if they actually wanted to. That's not the real issue. The real story, and the one nobody in DC or anywhere else on the planet seems capable of seeing, is abundance, something we have talked about many, many times. Here's why. While we're arguing over miles per gallon like it's 1997, China is building solar so fast that it's adding more capacity in a single year than the U.S. manages in several. Put another way, Beijing is sprinting towards energy surplus. Now, once they've got more electrons than they can use, Beijing can simply reprioritize all the leftover dinosaur juice instead of struggling to import it, refine it, or fight over it. All right, that is a massive, massive geopolitical advantage, no matter how you cut it, financially, strategically, militarily. Energy abundance equals leverage over anybody who doesn't have it. And here's the part most investors are missing. I think this sets up an investable opening that goes far beyond our borders and far beyond solar. Think about it. When a nation, any nation, not just China, when any nation moves into surplus energy territory, it can funnel desperately scarce capital into power-heavy industries the rest of the world will not be able to touch cost effectively. A few examples come to mind right off the top of my head, including next-gen manufacturing, AI data centers, rare earth processing, and industrial automation, just to name a few. That's where the real long tail opportunity lives and profits reside, which is why you and I, as in we, want to pay very careful attention as investors. You know who, by the way, gets it. Yep, him, Uncle Elon. Be sure you do too. Buy where the electrons are going to be cheapest. So Keith's investing tip in this department, history shows very clearly that abundance is a freight train you want to be in front of, not under. Think about that one for a moment. Today's bottom line, tune out the noise, keep your eye on the prize. Your portfolio will thank you. You got this, I promise. And as always, let's make it a great day. Thanks for watching. I'll see you tomorrow.